Understanding the difference between intrinsic and extrinsic values in trading options. It is essential for any trader looking to take advantage of the market. So we're going to dive into what these two values are. We're going to provide some examples of them in action, discuss factors that can affect their movements. So one of the key concepts in options trading is that distinction between intrinsic and extrinsic value. The intrinsic, that's the amount by which the option is in the money, meaning the difference between the underlying asset market price and the strike price of the option. So for example, if you have a call option, strike price of $100, and the underlying market price is $105, then the intrinsic portion is $5. On the other hand, the extrinsic value of the option, that is the amount by which the option is out of the money, or the difference between the option's market price and its intrinsic value. So in other words, the extrinsic, that reflects the time value and the volatility of the underlying asset, as well as the option's expiration date. So for example, if your option has a market price of $3 and an intrinsic value of $2, then the extrinsic value is $1. So in trading, you got to understand the difference, right? Because they can affect the option's price and the potential profit or loss from the trade. So if the underlying asset market price increases, the intrinsic value will also increase, while the extrinsic, that may remain the same or even decrease. And that means that the option's market price may also increase, potentially resulting in a profit for you, the option holder. But it's important to keep in mind that the extrinsic value, it's time sensitive. That means it decreases as the option gets closer to expiration. This means that if the underlying market price does not move in the expected direction before the expiration date, the option's extrinsic value will decrease, and that's going to result potentially in a loss. So there's two main types of conditions that you need to know. In the money options, ITM. So an ITM, it's an option whose strike price is below the current market price of the underlying asset. Simply put, this means that if you were to exercise your option right now, your ITM option, you're going to make a profit. So let's say you have a call option on IBM. Strike price is $100, but right now the IBM market price is $105. This means that your call option is in the money because it has an intrinsic value of $5. It also means that if you were to exercise your call option right now, you'd make a profit. Out of the money option, an OTM, that's an option where the strike price is above the current market price of the asset. So this means if you were to exercise your OTM option, you would make a profit? No, you would take a loss. So going back to our previous example, let's say IBM's current market price is $95, not $105. This would mean your call option is out of the money because it does not have intrinsic value. It's zero. It also means that if you were to exercise your call option, you would take a loss. So at NetPicks, we teach our traders to mostly use option strike prices when they buy them that are 1 to 2 strikes in the money. So this allows our position to have value right from the get-go, even if we have a little slightly negative move against our position during the course of the option. So understand the difference between the intrinsic and extrinsic value. It's pretty important for making informed decisions about when to buy or sell an option. So in general, having an option that is in the money can help reduce your risk and increase your potential profits. An out-of-the-money option will have a higher extrinsic value, but also greater risk because the market may not move in your favor in time. Again, we make sure here at NetPicks, we want to teach our traders strategies to maximize profits, minimize the risk. And this is one way we do it, ITM options. And you understand these concepts, you can make more informed decisions when you trade options. You have a better chance of making profitable trades because when you buy one that's in the money, you already have intrinsic value, and any moves against you, there's a bit of a cushion. If you want to get started trading options, we have an 8-minute options cookbook guide. You can learn how to generate profits 5 different ways. Only takes a few minutes a day. Link is here to the left. It's below in the description. Thanks for watching.